Hello and welcome to the final module of our series where again we are going to be talking about fundraising. We had touched upon fundraising in our sixth module, and as I told you back then, that fundraising is going to be divided into two modules. Now I feel that you are in a position with everything ready that you can move on to the final aspects of fundraising, understand what it takes to fundraise. We're going to touch on some basics and then dive deeper into what happens beyond the first conversation, beyond the first pitch that you've made, how fundraising moves for different stages of your company. What are some of the important clauses, terms, and conditions that you will find in standard term sheets? What is negotiable? What is non negotiable? And then we'll quickly run through a recap of our entire course. So, fundraising 2.0. Before we move on, let me ask you a question. What do you think investors want to hear? What is the one thing, the most important thing that they are looking for? Well, maybe some of you guessed it right. They are asking the question, how will I secure my exit? That's what matters to them. How will my money make me more money? Right? And there are a few indicators for exit. How do you showcase a bigger exit opportunity? One, by obviously showcasing a big opportunity size, a big market size that you can go after. Two, the background of the founders. And we've talked enough about why the background of the founders makes sense. Third, early traction. No matter how great your idea is, if you don't have early traction, most investors are not coming in today. Fourth, you have a clear business plan and a clear roadmap to profitability. And five, what is your fundraising strategy? How much money are you going to need? How long will that let you be in the business? What are the milestones that you're going to achieve with that? And when are you going to need more money to grow? So these are five main things that clarify whether investors would want to come and jump onto the bandwagon with you to join your rocket ship or not. Now, there are different types of investors. Right? We've discussed this earlier, but now we discuss it a little more in detail. So first we have, when we talk about professional investors, right? So first we have angel investors. They are usually looking to invest at a very early stage. They bet on a strong founding team, and a lot of them do come in before product market fit, but today a lot of them are also coming in post product market fit. So that's the time that they come in. They are looking for organic traction, they are looking for repeat customers, and a lot of them are also looking for low capex models that do not require too much initial investment, let's say in machinery, hardware, technology, infrastructure, for you to be able to grow and reach that level of scale. A lot of them invest with safes or convertible notes. Again, considering they are investing majorly on the founders at this moment, there is not a lot of traction to showcase a clear-cut valuation, but some of them might also insist on a priced round where there is a valuation that is created for the startup. Then we have VCs. Typical VCs usually join a company for scaling. They're looking for scalability. They're looking for the potential of the startup beyond the initial product market fit, beyond the initial early traction. So they are looking in at how fast can they get to that 100x growth of your company. Right? They are looking at low customer acquisition costs, high lifetime value of users. They're also looking for maybe high gross margin. So tech products, when you build, you have higher gross margin. So that is what they are looking for, that the money that we spend comes in at acquiring customers and creating habits, but then once the product comes into the market, it can eventually cover the money that has been burnt. This is usually seed, series A, and beyond that. Then you have micro VCs and seed funds. These are people who are looking at a high risk, high reward kind of a scenario. They are typically going to invest at an early stage, definitely post initial traction, post your MVP. They are also looking at some kind of organic virality in case you've done something in terms of your GTMS, you've been smart enough with some hacks that you've done that have given you organic traffic. They're also looking at how your community is engaging with your products. So today it's not just about your product, it's more about your distribution. So your distribution comes in the forms of communities as well. So this is again something that they are looking for. They are flexible in terms of the valuation, uh, but they want you to reach the milestones faster as compared to your angel investors. Then there is another kind of investor, which is our corporate VC or strategic investors. Basically, uh, a lot of companies have a dedicated portion within their company's financial budgets allocated to investment in adjacent products, similar products, or products that could either complement their existing range, supplement it in some way, or someone who could potentially become a competitor in the future. So they try to invest in those companies as well. Or if they're looking to diversify into some different sector, so they have some amount of budget kept for corporate venture capital, that is what we call it, right? And these people are looking at strategic partnerships. They are looking at taking over your R&D, basically taking over the technology from you, and then either using it in their own product or something, integrating it. It could turn out to be a merger or acquisition later on. And they are also looking at expansion potential. They take up minority stakes. Again, they would come in with a priced round. So they do take up minority stakes. They also prefer some kind of control over the board. So they would either have some preferred shares or board seats wherein they have some amount of control. Finally, you have another alternative to funding, which is the venture debt or revenue-based financing. So again, these are ways of non-dilutive funding wherein you do not give out equity, but rather take it on as a debt. These are alternatives that come in when you have a strong cash flow. There is some consistency, predictability in your cash flow, and usually if there are some positive margins. Again, this can be used as short-term lending. It could be structured as debt. There is flexibility in that model. Your valuation does not matter. Now moving on to the next concept, which is default alive versus default dead. How long will a startup survive if it does not raise more money? So there are two categories of companies. One is a default alive company, which can reach profitability with the existing money that it has raised. And then there is a default dead category of companies, which will run out of cash, which will burn all the investments, all the money that they've taken it up until now, and they will require more rounds of fundraising going forward. There is no right or wrong answer here, but both of them have their own pros and cons. If you have, let's say, a default alive company, obviously you can understand the default pros over here, right? That your company will reach profitability, it might not need external investments in the future, but there's a con to this as well. This means that your initial investors might not get secondary exits in the next rounds. So that is one con with this kind of a strategy. The other, obviously, you need more money. So again, the company can die anytime. It might not raise additional funding in the future, but there's a possibility that it will raise more money in the future. And with that, the initial investors might get some amount of their money back or make some returns on their initial capital with secondary exits. Your fundraising strategy will also depend on the stage of your company. So let's say if you are a pre-seed or you're looking at an angel round, you need to showcase PMF validation. Basically, product market fit has to be there. You have to show some kind of early traction, and it will come in the form of safe notes. Yes, it is very probable that you can do it in the form of safe notes. They are becoming increasingly popular today. Now moving to a seed round, this over here, you have to show some kind of revenue growth. Let's go back to our GTMS class. We had created a important KPI, which was week on week revenue growth. Now, this is where you showcase your week on week revenue growth, or if not that, then at least month on month revenue growth, and you can get a seed round. A seed round will usually come in for supply chain optimization, to better your product, to improve the service offering that your company has. And again, this has to be a priced round. This cannot be a convertible. 90% of seed rounds today are not convertible rounds. They are all priced rounds where there's a valuation set and there's an equity given out. Next, you have your series A, B, C, and beyond. So series A will usually come in for scaling up operations. You have established your product service in one market. Now you want to expand probably into different markets, into different marketing channels. So you can have an omni-channel strategy. Usually comes in at about 10 to 20% of dilution. Again, it's just a ballpark. Beyond Series B is about consolidation of the market to achieve a bigger share of the market that you are working in. So this is about market leadership, global expansion. A lot of times at the later stages, you will also see involvement of PE firms, which are private equity firms. Right? So that is your fundraising strategy based on the different stage of your company. Next, how do you approach fundraising and close deals faster? What can you do to speeden up the process of getting more capital into your company? One, obviously, you will have to do investor outreach. You will have to make a lot of pitches. Now the best way, obviously, is to get warm introductions. If there are people in your network that you can reach out to who can further connect you to investors or prominent angels, that's a very good way to start. If you look at it, we are connected to everyone else in the world by a maximum of 7 degrees of connection. You just have to unlock the right connection to the person that you want to reach out to. So do invest on networking. Again, if you want to learn networking, join our Founder Superpowers course, where we also touch upon networking and help you become a power networker. In terms of investor outreach, if you can't make soft introductions, or if you can't get those warm intros, then you move on to cold outreach. Again, it's not a bad way. If there is no other option, then this is the best way possible. Now over here, don't be spammy. Try to tailor your pitches or your communication to the person that you're reaching out to. Please don't send the same message to everyone. Make sure that you do enough research about the person, about the portfolio, in terms of the companies that they've invested in, so you know that person and what they are looking for, and then tailor your messaging accordingly. If you can personalize your messages, that does create a better impact and helps you stand out from the rest of the world, which is just going to be sending the same copy-paste template message. So do use GPT, do use other AI tools, but definitely try to personalize your messaging. Make sure that it is short, to the point, crisp, and not something that looks spammy. Create your pitch decks that are VC friendly. In the previous module, we showcased what it takes to create a standardized pitch deck. Don't deviate too much from that. Try to stick to it as much as possible, because that is again something which is very standard, that is followed everywhere, and people will be able to follow what you're trying to communicate. So that's about the initial conversation and getting a foot into the door. Once you get a foot in the door, you will have multiple rounds of interaction with your potential investors. No one just hands you the money immediately. So you will have to explain your idea to them. It might take some time. So do plan for that time that it's going to take, at least 3 to 6 months. Give yourself that kind of timeline to be able to raise funding, to be able to showcase to your potential investors that you are making incremental progress with or without them. And if they are not coming with you, they are losing out on something. And once you have some kind of an agreement with them, you will get a term sheet. There is going to be a bit of negotiation, either in terms of valuation, the equity, the different other terms and conditions that we're going to understand in a bit. Be transparent. Don't try to hide any kind of information, because there is going to be due diligence. Once the term sheets are signed, that does not automatically mean that the commitment to give you the money is is happening, or you're getting the money immediately. Post getting a term sheet, post signing the term sheet, there is going to be a process of due diligence where you share your details with your potential investors, and everything that you've pitched up until now needs to match with the official documents that you present to them. And there are going to be a lot of clauses. Again, that's what we're going to cover in the later part. Once you have the money, congratulations, you've raised the money. Now the money is in your bank. How do you deploy that capital? In fact, I was speaking to a founder recently, someone very close and in my network who'd raised a $2 million seed round. And his problem was that now that I have the money, I'm not sure how to invest it because the money is just lying idle in the bank now. I don't probably need as much of it. So make sure that you're raising only that much that you want to deploy in the next 12 to 18 months. Have an idea in terms of exactly where it's going to go. And then once you get the money, get on with it. Don't wait for moments to pass. Make sure that you're doing good utilization of the capital that you've gotten in order to scale your business, to grow your business, right? And another thing that you want to keep in mind is investor reporting. A lot of times it is mandatory, but most of the time it's just good to do, right? It's not just because you want to keep them in the loop, but not just in the bad times or the good times, but always, because they will be able to help you out, bring in strategic partnerships, or maybe if you're about to run out of money and you just go to them at the last moment, that doesn't look good. So if you keep them informed, maybe on a monthly basis or a quarterly basis, they will know the runway that you have and they can help you out with bridge rounds. Bridge rounds are basically rounds that are done which are smaller in amount but help you reach or extend your runway to the time that it takes for you to close the next round. So they can help you out with that. Keep them informed. You could also ask them for references in terms of hiring. So keep your investors involved, not just in terms of your progress and your runway, but also in terms of the resources that you need, whether it's some industry introductions or some kind of talent that you need. Most of the times your investors might be able to connect you to people who would fit into those roles. So now let's move on to understanding a few things that you need to avoid while raising funding. Don't scale too fast without looking at retention. This is one of the mistakes that I have personally faced and I've learned from it. During my first startup Signcart, we were expanding at such a crazy pace that we were not paying any attention to our existing customers. Cost of acquisition for new customers was so low that getting a new customer was much cheaper than retaining an old customer. But in the long term, that did cost us very heavily. So focus on retention, focus on making your existing users very happy. And once you have that kind of a relationship with your existing users, that's when you move on to blitz scaling, right? And a lot of companies are unable to maintain the same quality standards while blitz scaling. This is something that you should avoid. Second, don't rely too much on paid advertisement. Ensure that there is enough growth loops, there are enough viral loops, there are enough ways of you to get organic traction, right? So organic, there is nothing better than organic growth. Your paid advertisement, paid channels will give you a boost, but ensure that when the paid channels are cut off, you still continue to grow organically. There is some amount of traffic that is coming to you, irrespective of you running ads or not. Third, a lot of people have unrealistic valuations without having solid numbers backing that, without having solid unit economics. So ensure that you have your valuations are determined based on your traction. Yes, you can put it a little bit in the futuristic tense in terms of what you can do, but in order for your assumptions to hold true, there has to be some kind of something backing those numbers. So ensure that you have that. A lot of times D2C brands, software brands completely ignore offline expansion. So while you're expanding, please ensure that you have a offline strategy as well. Today, it's imperative even for D2C brands to have some kind of an offline strategy to create that trust. And again, don't forget, we are all social animals. And my prediction is, with the amount of tech that we have around us, there is going to come a time that we would not want so much tech. We would go back to our basics. We would want to go out, and we would want to see the brands that we interact with in the digital space also being present in the offline space. Now, moving on to the next topic, which is alternatives that are beyond VCs, right? A lot of you have been chasing VCs, and it might seem like an eternity. You've heard enough no. So what else can you do? Right? So you have revenue-based financing. People who fund your operations based on letters of interest or give you an advance against an order to produce it. So if you are able to sell something and you don't have it yet, you can get revenue-based financing. There are private lenders, there are NBFCs. You can also enter into brand collaborations, strategic partnerships with existing companies. And the best way, honestly, is crowdfunding. So don't forget that. Use crowdfunding and pre-orders to increase your fundraising, to improve your cash flow. If you're able to get money before you have to create the product and ship it out, there is nothing better than that. There are different kinds of investors, and you need to understand who you are pitching to while you're fundraising. So investors could be different based on the kind of products that they invest in. Some could invest only in D2C brands. Some could be very industry specific. Some could be scale specific, like they invest at a particular scale. Some come in early, some come in at a later stage. So don't waste your time pitching to someone who's not relevant to you for the stage of the company that you are at. You also want to understand what is the priority for that particular investor. Is that investor looking for a great revenue growth, or are they looking at profitability? So you want to understand whether it's growth for them, whether it's revenue, whether it's profitability, or whether it's just the industry that you're operating in and they see a potential in the future for that industry and they want to get in early. So you want to understand what are the priorities of your investor that you're pitching to. Again, you can always tailor your campaign, your fundraising strategy based on the people that you're pitching to. One good thing, again, fundraising is also a little bit about psychology and how you can play to the psychology. Don't overplay this. You can create some amount of FOMO. Again, this is a strategy that has worked for some people. When you are fundraising, one person of your founding team, ideally one of your founders, should be involved in fundraising 110% of their time. That is what they got to devote, right? Forget everything else. When you're in fundraising mode, that is the only mode that you have to be in. So put your blinders on and get into fundraising. And when you're fundraising, don't keep a long 6-month target. Keep a 1.5 month target where every day you are meeting at least 2 to 3 people. Try to set up your calendar in a way that you're fixing 2 to 3 meetings per day. Now, this does two things. One, the investor community is usually very connected. So if you do reach out to one of them, the opportunity will pass on to the rest of the people. And also it does create FOMO, because once that network starts talking, the privileged network, the connected network starts talking, and they figure out that you are fundraising, and if you are amazing at what you are doing and the opportunity is very limited, most of them would want to come after you. So you can create some kind of FOMO over there. Again, this also does some amount of signaling. Signaling basically is your initial investors backing you in the next rounds. Now imagine someone who came in as an early investor who does not invest in later rounds, who's okay with getting diluted. Most of the investors would want to retain the equity that they have, right? And if they don't come along with you, that does signal to the other investors that your initial investors are not very happy with you. They might not have bigger pockets to come up, but most of them do, and most of them do come in follow-up rounds, and that does create a very positive image. So once you have your first round, see, first round is very tough, is usually the toughest round, but once you've cracked the first round, for subsequent rounds, if you can convince your existing investors to come along, that becomes a great pitch to other investors also who might join a later round. A few green flags that investors are looking at. One is obviously the team, the strength of the team, the experience of the team, the background of the team, how prepared the team is to tackle the problem, how motivated the team is to address this particular problem. Is there some kind of a personal story why the team wants to solve this problem? What is it that is beyond money that will motivate this team? Why would someone want to stick even in the bad days and not give up on your money? So you investors are looking at the team from all these aspects. Next, they are looking at the value proposition of the company, a clear, compelling, unique value proposition. Again, you can go back to the GTMS module and see how you create a clear, compelling value proposition. And if you have some kind of market validation with your prototype, with your initial product, with your MVP, whatever the case may be. Next, your business model makes sense. It is viable. It is not something which is a dream. It is not something which is very far-fetched. 10 years down the line, we'll be able to monetize what we are building today. It does not make sense from an investor's perspective. They have a shorter duration within which they want to make money. So your business model needs to be viable, but it also needs to be adaptable. It should be able to change to the market dynamics. We are living in an age of AI. Things are getting disrupted very fast, and so are business models. Business models that worked in the past might not work in the future. So your business model needs to have that kind of adaptability for you to be able to capture the market, to take advantage of the newer trends and go forward. In terms of compliance, a lot of times early stage startups don't do compliance. They don't ensure that the regulatory requirements of a particular state, country where they are operating are being met, right? So you might get a term sheet, but the deal will fall off during due diligence because you have not done enough compliance. There is something missing. You haven't paid your taxes, GST is pending, labor laws. So be aware of all those things, get expert guidance. It might cost you a little bit initially, but if you are very serious about fundraising, ensure that your company is compliant. Compliance also helps you build trust. It creates a company for scaling up, right? And it's built for long term. Next, they're looking for execution. In terms of execution, what is the turn rate? In terms of your ideas, how fast are your ideas getting implemented? And what is the speed at which they're getting implemented? So both these things are very important. The final topic for this module is the different clauses that you're going to see in a term sheet. I just wanted to clarify all of those things for you so that you are aware of what is coming your way and you are ready to see all of those things. First, obviously, is going to be your valuation. If you're doing a safe or a convertible note, the valuation part might not be there. You will have limits, etc. But other than that, you will have a valuation. Very simply put, the next thing is going to be the amount of money that is coming in. How much are they investing? How much, if you're doing it with a group of investors, what is a different group of investors investing? If it's a syndicate, whether it's a VC, but whoever is putting in however much money, that is going to be listed. Based on the first two, they will come up with ownership in terms of the company's equity or the cap table. The amount of money they invest divided by the total value of the company will give you the ownership. Next, there are going to be some dividend rights. Again, for early stage startups, even for pre-IPO, a lot of startups, even at the growth stage, there are going to be no dividends. So this is again something that is very negotiable. In fact, most of the clauses that we are discussing right now are going to be negotiable. Then there are going to be dilution and anti-dilution clauses in the term sheet. So dilution is basically when more investors come in, how are your shares getting diluted? How is your ownership getting diluted? If you are raising a round, a second round at a lower valuation, does the person's valuation go, equity stake go down? Does it remain the same? So all of those things are going to be included in this part. A very important clause is going to be a tag along clause. This is basically to protect the rights of minority shareholders. Imagine me as an angel investor investing in your company and I hold a 5% stake. 2 years down the line, your company has become profitable, you've grown a lot, and you end up selling 95% of your stake to a third party. What happens to me? Right? This is to protect me in that kind of a scenario. This is where I have a tag along clause in the agreement wherein if you end up selling your shares, I have the right to sell my shares to the same person at the same price that you are selling them at. So that is a tag along clause. Then conversely, we have a drag along clause. Now imagine you have 95% of the stake, I have 5%, same scenario, but this time you want to sell the company and I am resisting. The buyer wants to buy 100% of the company. Now, considering I have majority stake, I can convince you, I can force you with a drag along clause to sell the entirety of your stake as well at the same price that I am selling my shares, but because the buyer needs 100% ownership of the company. So this is a drag along clause. It is there to protect the interests of the majority shareholders. Next, there is a right of first refusal. I pointed out earlier in the signaling theory that your initial investors have the right, should ideally come in to invest in the next rounds, but there could be scenarios where you probably don't want them. But these investors, early stage investors, would usually have a right of first refusal, wherein before finalizing, suppose you don't ask them to invest in your next round, you go out to a third party, you go and get a term sheet from the third party. You are legally obligated to present this term sheet to your existing investors and ask them to match the same terms and conditions. You've done the hard work, you've gone and negotiated. Initially they said no or you did not want them, but now that you have a deal, they don't want their own shares to be diluted as much, so they have the right of first refusal. If they refuse to participate in the round to maintain their equity or grow it, then you can take the money from the third party. Otherwise, they will be the ones who will come in at the same valuation, same terms and conditions that you already negotiated with someone else and you are about to take. Then there are liquidation preferences. When the company goes under, when it dissolves, maybe it did not achieve its objectives and now finally it is getting dissolved. Whatever assets that the company has get liquidated and everyone is paid back. Now, everyone is not paid back in the same proportion. There are liquidation preferences. The person who comes in last puts in a liquidation preference. Maybe they get at least 2x of the amount that they initially invested before anyone else gets paid. So liquidation preferences kind of stack up on top of each other. This also comes in during liquidation events wherein you have sold your company and there is an amount of money that has come in. The person who has the most amount of liquidation preferences will get paid first at whatever X of their multiple in terms of the investment that they've made initially before anyone else in the ladder gets paid. So again, be very mindful of liquidation preferences as well. Then there are voting rights or board seats. You might have heard of a lot of founders being kicked off from their own companies. This does not mean that they let go of the equity, but the board has the right to select the CEO or to veto some of the decisions, to veto a sale. So you want to understand who are the people that you are giving out the voting rights to. Again, my suggestion, do not give out voting rights or board seats at a very early stage. Try to do this. I mean, at later stage, it will become inevitable, but try to keep as much control in the beginning by not giving out too many voting rights or board seats. When we do fundraise with a safe note or a convertible, there is a valuation cap. Now, convertible notes are simply that, imagine I am giving you money today, but considering you don't have enough traction, we can't come to a conclusive valuation right now. We will come up with a valuation at the next round. Whenever you are raising money next, whatever the valuation is, then I can take a discount on that valuation. Suppose you come up with a valuation in the next round at 10 CR and I have a 20% discount rate. That means the valuation for me is going to be 8 CR, and the amount of money that I invest today will convert into equity at that stage, not at the 10 CR valuation that you're getting for everyone else, but at the 8 CR valuation because I came in early. Now, when you do a round with a convertible note, there is usually a cap on the valuation, right? So you've invested initially, but you've grown so much that initially the target that you had was between 5 to 10 CR, but you are raising at a valuation of 50 CR. And even if I get a 20% discount, then my initial bet does not compensate for the risk that I have taken. So in order to protect the early investors who are investing through a convertible note, there is usually a cap or a ceiling put on the valuation. Even if you raise at, let's say, a 50 CR valuation, the valuation that my stake would convert into equity is going to be at a 15 CR, right? So there is usually a cap in that kind of a scenario. Then there are confidentiality clauses. Obviously, once the investors put in money, there are going to be confidentiality clauses in terms of, it could be non-compete, it could not be non-compete, but it could be about sharing your proprietary information, trade secrets, or anything like that. Non-compete usually does not hold true in India. It does not hold true in the legal battles that are conducted in India, whether it's for employees, whether it's for investors. So again, if you really want to put it, you put it, but I'm not sure whether a lot of people are going to agree to it. Indemnity, a lot of investors will put in the indemnity clause. This is basically, indemnity is if you as a founder do something wrong with the company, the investor puts in an indemnity clause that separates them from you. That is, that they are not going to be liable for the actions that you take for the company. So there is going to be an indemnity clause. That's all, folks. We have almost come to an end of this module. That is all that we covered. Again, if you have any doubts, any questions, we are more than happy to answer them. You have our email address by now. So write to us and we will reply back with our feedback, suggestions, or clarify your doubts. Let's do a quick overview, a recap of what all we've covered in the last 8 modules together. We started off the first module with an entrepreneurial mindset, where we covered the Delta 4 framework. We understood what it takes to create or destroy wealth by the means of your startup. We understood hypothesis testing and gave you a framework that you can use whenever you are starting a new product, a new service, a new company. How can you identify opportunities that will make you money in the future? And again, in a very scientific and a structured manner. Next, we moved on to innovation, how the best innovators of the world think, how they act. And here we talked about first principles and design thinking. We created user personas and left you with some frameworks and some tools that you can use to design solutions for your product. Next, we moved on to MVPs, wherein creating basic landing pages, creating basic prototypes, understood from the best in the world as well as in India how they created their companies by the way of creating MVPs first, which have scaled on and which have become billion-dollar companies, which have gone on to become unicorns, some of them even IPO'd. We understood what are success indicators, what are some initial KPIs that you can set to track the progress of your MVP. Next, we moved on to the GTMS module, where we understood what all is there in a go-to-market strategy, the pricing, the positioning, the competitors, the business model, all of those things were in there, and we gave you a 7-step framework that you can use to create your own GTMS. By the end of it, we also left you with a three-part framework that you can use to create your value proposition. Again, things that directly translate into your pitch deck. In module 5, we understood what it takes to convert your narrative into a financial model. Why is it very important to create a financial model? What it means for your company to be valued versus priced? What are the different drivers of value? What are the different risks that your company is going to go through from an idea stage to a late stage? What are the things that you should be worried about? What are the different ways of valuation? And then what are the key indicators that investors are looking at? In module 6, we understood what it takes for you to get investments, what are investors looking for, what are the different kinds of investors, what are the alternative ways of funding that you have. In module 7, we covered the pitch deck, most important aspects of pitch deck. I showed you a pitch deck that got me offers of 2.5 CR. I also showed you the best possible pitch deck and made you understand what is the psychology that you want to use if you want to persuade investors to come on and join your bandwagon, to join your rocket ship. Finally, in the last round, we again covered fundraising, the parts that we missed out in the first module. We understood what happens beyond the first conversation. We understood what it takes to raise funding based on the stage of your company. And then finally, the important clauses. There are probably going to be more clauses, but some of the more popular and important clauses and terms and conditions that are going to be there in your term sheet. Once again, thank you very much for being a part of this. Thank you very much for joining us on this journey. I hope this was useful for you. Even if you take 20% of the learnings from this, do implement it. Share your feedback with us. If you want any guidance, any kind of support, do reach out to us. Once again, if you really want to become a great entrepreneur, it's not just the business that you learned right now. It's also founder superpowers, and that's the next course that I would urge you to get onto. We cover topics such as personal productivity, strategic thinking, negotiation skills, team building, leadership, hiring strategies, and much more in that. If you want one-on-one guidance, if you want support in building your tech, your marketing, or anything like that, do go onto our website and apply to our venture studio, where we take in about 5 startups every month and handhold them from an idea to an initial revenue stage. So any kind of help that you need in that, please do apply, and I look forward to seeing you soon. If you haven't connected with me up until now, I urge you to connect with me on LinkedIn, and I look forward to being a part of your network. Thank you so much once again. That's the end of the module. That's the end of the course. And this is Aditya Bajaj signing off.